But in the short term, it is speculative return that calls the tune. Speculative return is, to coin a phrase, speculative, and is altered from positive to negative over the decades as price earnings multiples are extremely volatile. Over history, PEs have usually raised from 10 times earnings, maybe a little bit less, to about 25 times, is usually the high, although they got to 40 times a decade ago, another big red flag. While PE ratios, when they are historically low, say below 10, they're highly likely to rise over the subsequent decade. Reversion to the mean. And if they have been historically high, say more than 20 or 25 times, they are highly likely to decline. Not certain, nor do we know when those changes are coming, so that makes the game a little difficult. So while certainty about the future never exists, there are probabilities always borne out. Applying reasonable expectations to investment return and speculative return, combining them, has proved to be a sensible and effective approach to projecting the total return on stocks over the decade. In the past century, for example, investment return accounted for that 9% I mentioned. Of the 9.5% annual return on U.S. stocks, that was an average dividend yield of 4.5%, and annual earnings growth averaging 4.5%. I used in my example earlier. And speculative return added a mere 0.5% of the total as the price-earnings ratio over that long period of time rose from 13 to 21 times. Just spread that out over 100 years, and that's what you get. So long-term in ownership of American business has been a winner's game. Now, I have to say something parenthetically here, and I want to be very clear on this. Market returns that I described are not investor returns. What the market gives is not what we get. What investors get is the market return minus the cost of obtaining that return to get their net return from that gross return. So if that market return is 9% and the cost of investing is 2.5%, not a bad guess, the investors are averaging 6.5%. That's the simple arithmetic. Now, I won't tax you too much here. It may not seem like a large number, difference between 9 and 6.5. But if you compound 9% and 6%, 6.5% over an investment lifetime, let's call it 50 or 60 years, get out your compound interest tables or your computers, ladies and gentlemen, and do the math, you will find that the 6.5, that difference of 2.5 percentage points eats up approximately 75% of your lifetime accumulation. Compounding 9%, don't have the number right here, and subtract the compounding 6%, 6.5%, and the 6.5% number is going to give you about 25% of the market return. And so you can look that up and check it out. Do the math and get out your compound interest table or your computer. So think about it this way. You, the investor, put up 100% of the capital. You, the investor, took 100% of the risk. And you, the investor, got 25% of the return. And Wall Street put up 0% of the capital. Wall Street put up 0% of the risk. And Wall Street got 75% of the return. We can do better, I think. But I digress. These simple insights based on the sources of stock market returns provide a solid framework for understanding how markets work. But it's only been in later years that I've come to understand the extent to which speculation in the financial economy is interlinked with productivity in the business economy and can profoundly link, get straightened down here, moving around, changes influence, it can profoundly influence changes in it. When I learned of the work of the great American economist, very little known, Keynes-Minsky, 1919 to 1996, who dedicated his late career largely to what he described as the financial instability hypothesis, essentially that stability leads to instability, I knew I had found not only many important insights into how the world works, but a distant early warning of the financial crisis, the financial storm we're now trying to weather. In 1974, Minsky observed the fundamental linkage between finance and economics. The financial system swings between robustness and fragility, he wrote, and these swings are an integral part of the process that generates business cycles. The prevailing financial structure is a central determinant of the behavior of the capitalist economy. This is deep economics. Likewise, the dynamism of profit-driven motives influences economic activities within the context of a given institutional structure, a structure that is itself ever-changing. Referring to the ideas of economist Joseph Schumpeter, Minsky emphasized that financial markets will not only respond to profit-driven demands of business leaders and individual investors, but also as a result of the profit-seeking entrepreneurialism of financial firms. Nowhere, he says, are evolution, change, and Schumpeterian entrepreneurship more evident than in banking and finance, and nowhere is the drive for profits more clearly the factor making for change. He wrote that a long time ago, in the early 1990s. In Minsky's theory, the financial system takes on special significance, not only because finance influences a powerful influence on business activity, but also because the system is particularly prone to innovation, as would become abundantly clear during our recent era. Since finance and industrial development are in a symbiotic relationship, financial evolution plays a critical role in the dynamic patterns of the economy. This all written almost 20 years ago. Minsky placed a heavy focus on the firm's financial structure, under which in return for debt capital, the firm contracts for a schedule of repayments to its lenders. He defined 3 ways in which a given firm, or a government for that matter, can use its assets to fund its liabilities. One he called hedge financing, in which the prospective cash flows are sufficient to cover both interest payments and the amortization of the debt, so it's finally paid off. Number 2 was speculative financing, in which cash flows are sufficient to pay the interest, but insufficient to pay the debt coverage, the principal amount of the debt as it comes due. And 3, Ponzi financing, his choice of words back then, in which cash flows from operations are insufficient to meet interest payments. The obvious option for such a firm or government are either to increase its indebtedness or to default. These definitions, which Minsky set forth in 1994, represent an almost prescient warning about the failures of our flawed financial system that have proved so harmful in the recent era. They also stand as a warning of the fragile financial underpinning of our federal government, to say the least, and many state and local governments today. Ponzi financing is not an unfair term. Minsky recognized the obvious perils of what we call securitization, taking assets, securitizing them by issuing bonds. Financial innovators and marketers, he wrote, did not hazard any of their wealth on the longer-term viability of these underlying packages of mortgages. And this was not the most recent mortgage crisis he was writing about. It was the savings and loan crisis of all those years ago. Obviously, in such packaged financing, the selection and supervisory functions of lenders and underwriters is not as well done as they might be when the fortunes of the originators remain at risk over the long term. All that was required for these originators, these creators of these obligations, to earn their stipend was the skill to avoid obvious fraud and in structuring the package. Remarkably, Minsky had this insight on the link that got broken between borrowers and lenders. That's what happened way back in 1994, as I said, long before the issuance of these complex and highly risky credit default swaps, CDSs, collateralized debt obligations, CDOs, specialized investment, structured investment vehicles, SIVs, these acronyms that characterized the era that has now come to its crashing conclusion. It's too bad we didn't listen, isn't it? Now, let me sum up how our business values and investment values have gone awry and the consequences of this failure. I'll first cite the grave concerns raised by both Keynes and Minsky, and then add my own perspective. I will finally get into the Keynes-Minsky Act in just a few anticipatory moments. Keynes' famous paragraph can hardly be more incisive. Here's what he wrote. As the organization of investment markets improves, the risk of predominance of speculation increases. Speculators do no harm as bubbles on a sea of enterprise. But the position is serious when enterprise becomes a mere bubble on a whirlpool of speculation.